Good afternoon, everybody, and welcome back to Series 8 of the Climate Pioneers Show. If you're one of our regular listeners, you will know by now that every series we focus on a different topic. And what better way to kickstart 2025 than by interviewing experts from some of the UK's leading climate investors? I'm going to be asking them for their reflections on 2024, what their predictions are for the market in 2025 and the technologies they're most excited about investing in. And crucially, I will be asking for their advice that they would give to founders who are looking to raise investment this year. And today, for episode number 4, I am joined by Jeremy Brown, an investment principal from Anthemis Capital. Jeremy is head of climate strategies at Anthemis, and he focuses on seed to Series C investments across Europe and the USA, with a particular interest at the intersection of climate and fintech. So, Jeremy, thank you so much for joining me today.
Thank you. Thank you for having me, Terry.
My pleasure. So I've given a little bit of an intro there to you, your focus, and a little bit around Anthemis, but are you happy to give us just a bit more context, I suppose, on Anthemis as a fund, a bit more about the broader investment thesis, and then perhaps a bit more detail around your role particularly?
Yeah, absolutely. So should I give a little bit, I can give a little bit of background about myself as well, too, and then kind of the journey to climate. To start with myself, I'm head of climate strategies, as Terry mentioned. I actually started my career as a scientist. So I did my PhD at Stanford a long time ago in geophysics, which kind of set me up to be in the world of energy and be in the world of what future climate tech would look like. Actually started my career around sort of the clean tech 1.0 bubble back in the late 2000s, and have been able to see the journey since. Worked in the oil and gas industry, building software, post PhD, went back to California for business school. And since then, I've been predominantly in the deep tech early stage investing world. And that includes, climate and built environment and industrial tech and all of these sort of subsectors when people say sort of deep tech or climate tech broadly. At Anthemis, I think it's a super interesting proposition around sort of our investment thesis that we've built over the past few months of this intersection with climate and fintech. And so when I talk about, this intersection, I'll dig into the thesis why we're excited about it in a second. The origination of this is, Anthemis Group has been around for approximately 15 years. I would say in many circles we're known as a fintech investor, but it's a lot broader than that for us. We are investors investing at the intersection between financial services and technology, which is as broad as it can get because financial services essentially touches every sector of the world economy.
Yeah.
And over the years, we've not only have been deploying out of our generalist vehicle, which is early stage, but we've also, had focuses on female founders and launched a pre-seed fund to invest in female founded companies. We've had a health tech focused fund focusing on sort of that intersection between fintech and health tech. We've done that with insurtech as well, too. And so as we see fintech and financial services evolve, we are always seeking to be at the forefront of really sort of, establishing our foothold in market opportunities that we see where, we can have an outsized impact as an early stage investor. Anthemis, we're London and New York based. I sit here in London. We have approximately about $1 billion under management, and we have 28 team members across the globe, predominantly in New York and in London. Okay, so I think I went through the introductions and everything there. I will dive a little bit now into thesis. Anthemis's broad thesis is everything around sort of the future of financial services, intellectual capital, human capital, the virtuous cycles that we want to build to essentially create a more inclusive financial ecosystem. And that is done a lot by investing in early stage founders that are trying to change that industry. And so back in 2010, when everyone was talking about payments infrastructure, we were saying fintech. When everyone started, saying fintech, we were saying, embedded finance. As that's evolved, we're starting to think about, the next phase of our thesis, which, we'll be announcing, as the months and years go on here. But with that, my job has been to really think about what's that intersection look like between financial services, or let's say fintech, and what's happening in the burgeoning climate sector, and climate tech sector in Europe, which I personally, just given my background as a geophysicist, have always been excited about it. And I love that the world is, getting even more excited about it as the days and months and years go on. But really kind of putting sort of, the head to the desk and, writing and thinking. When we think about, I think broadly, what fintech, I'll start with fintech and why fintech, I think, has had the success that it has over the past 15 years, especially for venture capital investors. And so when we think about fintech, we think about infrastructure. When we think about AI, kind of what's happening right now, everyone's talking about what's the infrastructure that essentially needs to be built in order to have a lot of the application layers thrive, going forward, which is like both are billion-dollar companies, the Plaids of the world, more infrastructure in fintech, 10 to 15 billion, worth company. And then there's also applications that were built on top of that enabled, the infrastructure layer to, I guess, build some level of validation as the years went on. But when I talk about fintech infrastructure, what really resonates with me are a few things, because, in fintech, the tools were built over the years and technologies, whether that were hardware, whether that was software, whether that were like networks or protocols, that essentially required one to store and create and transmit financial data and complete transactions like online efficiently and securely. So if we take that as a baseline around sort of everything that sort of coalesced around that was fintech infrastructure, which led to everything being born around open banking, everything being born around banking as a service, everything being born out of KYC, like know your customer, AML, everything being born out of how do we actually aggregate data to create more hyper-personalized and hyper-contextualized products. And so when I think about climate from the position of a fintech investor, which I think is actually a unique angle to think about it, you think about kind of what systematically happened in fintech to get to where we are now, and essentially then what could be or should be happening in climate for us to get to where we want to be in terms of our societal goals. And I would argue kind of this hyper obsession with kind of infrastructure, kind of thinking about what are the future services that are going to exist in climate to enable the energy transition to continue to penetrate all levels of the world economy. What is going to be like the open banking equivalent? What's going to be the banking as the service equivalent? As an example, we're giving some thought to like energy data as a service. What's the infrastructure that's going to enable data to be aggregated to empower, let's say, a solar installer to more effectively, provide, better service to his or her customer. And so a lot of these things I think are very analogous. It's just, how do we sort of frame it and how do we continue to think about it in the future? And so when I look at sort of our broader thesis, it's very much, has a fintech element. So I get very excited about, what's going to be happening in the capital markets in the future, as one example. The world still very much the world of finance is still very much structured around the oil and gas era. It's not structured. The capital markets are not structured, at least right now at scale, to deal with the decentralized energy world, a world where energy is going to be a lot more volatile because of because of wind and solar and how intermittent they are. Green bonds are a thing, but they aren't, moving the needle in capital markets just yet. And so there's so much innovation to be done there. There's so much work that can be done to create more of a transparent market, a market that has, I think, more visibility to, more effectively, let's say, price offtake agreements, or think about purchasing agreements more effectively with PPAs. I mean, these are just examples, but I think the opportunity landscape is quite broad. And given sort of the deepness of the financial markets and capital markets, especially in the West, I think the world's our oyster to sort of continue to innovate there for the new energy economy. So I'll stop there. A lot more I can talk about around sort of different areas that get me excited, like in insurance and everything else, but I don't want to, I know you have more questions, so I'll let you ask me the next one.
No, it's interesting you mentioned that parallel there between the fintech market and the innovation that was happening. I mean, I was recruiting into the fintech space in the sort of late 2010s, around the time of, banking as a service, open banking really starting to take off. And I do feel some really clear parallels. Now I'm in the climate space and have been for the last 4 years around some of the burgeoning, like you said, infrastructure and that's starting to be embedded, and the sort of pace and excitement that wraps around that. So yeah, really, really interesting that you mentioned that. So looking back, first of all, at the year that's just gone, right? Looking back at 2024, how did you find that as a year, both for you as a fund, broader picture, but also I'm particularly interested in how you found that at that fintech climate intersection. How did you see the market performing? What technologies did you see start to take off? And were there any companies in your portfolio that performed particularly well in that period?
Yeah, no, I think that's a really, really good question or set of questions. So I think 2024, from when I look at broader macro environment, fintech obviously had a slowdown coming off of 2021 and 2022. The whole VC industry has kind of gone through a market correction and normalization. And I think 2024 was the year from an early stage perspective where, deal making was a lot more sensible in terms of valuations, in terms of, what we should be looking at and sort of expecting in terms of a growth path for our companies that we invest in. And then on climate, I think climate, may or may not have been or is currently in a bubble or in a mini bubble. And so I think a lot of investors coming towards the end of 2024, I even saw like in a couple articles, is climate tech dead? And like, absolutely not. But I think people were saying, okay, there's been so much happening in climate tech. Is this like another bubble? It's like, no, we just actually have to start thinking about what's the real things that we should be investing in. There's a lot of hype, and VC loves hype cycles. That's great. But then the hype settle and say, this is where we should be like sort of doubling down on our efforts and time. And so I think right now at the beginning of 2025, that's where we're at with climate tech. It's not dead, but I think LPs, like investing into venture capital firms, are going to want to know, from a thesis perspective, from a value creation perspective, like, do you really know what you're doing? And I think founders are giving a lot more thought to, I just don't want to build for the sake of building because everyone's building it. I want to do my diligence and talk to investors, talk to other founders, talk to the market, and figure out what's really going to stick, for a long time to build a very sustainable company. And so I think with climate, I think people are going to start saying less climate tech and just more, what kind of companies are we investing in that will essentially continue to move the needle with respect to climate change and energy transition. So like what I say, at Anthemis is, because we invest in, financial services and technology, I'm always saying I'm just very excited about investing in the future of financial services that's going to drive the energy transition and continue to do that. And however you want to articulate that, or the words that you want to tie to it, climate tech or not, that's at the end of the day, that's what, I'm doing. And that's how I think, we should be thinking about it. When I think about kind of exciting things happening, I can talk to like two of our portfolio companies. One's more on the growth side now, and one's still early stage. Both I would put into a broader climate tech bucket. So one's Agrina, which is a venture growth stage company that raised their Series B a year or two ago, and we participated in that round. And I mean, Agrina, it's based in Denmark, although they have an office here in London, is essentially incentivizing farmers to adopt regenerative farming practices, because that acts as a carbon sink. And so all those practices, once they're implemented, then you can essentially then take those carbon credits and then issue them to buyers. Which everyone in the planet is kind of scouring corporates, governments alike, for high quality credits so that they can say, I'm offsetting my emissions in some way, form, or fashion. And Agrina I think has had a wonderful journey. They have over 4 million hectares under management in Europe, which is one of the largest, if not the largest, with respect to this company profile. They just announced on their website a week ago they got their VERA certification, which essentially means this quality stamp to their credits, that now effectively buyers have some level of confidence, or more so, because of this certification, that what they're procuring or buying is good stuff. And so that journey has just been incredible to see the growth, and I think the market validation around regenerative ag, and that it can make a pretty formidable difference with respect to, reducing our emissions and helping institutions and corporates alike, offset them.
Yeah.
Another company that we invested in last summer, Berlin-based company called Carica, very much a sort of intersection, I like to say, of fintech, mobility, electrification. And so building a direct payments platform that's essentially directly connecting charge point operators, which is the infrastructure that if you have an EV, you're driving around and you're going to go charge it, charge point operator is going to be probably owning that infrastructure.
Right.
And then the EV driver. What the industry or what the market typically looks like right now is it's highly fragmented, and between the charge point operator and the EV driver sits a service provider. The service provider typically facilitates that transaction.
Okay.
But what that means is they eat into the margin of the charge point operator quite aggressively.
Right.
But because the market is relatively or getting more mature, these service providers technically don't need to exist. The charge point operators can handle these transactions via this Carica platform. And then what also Carica is providing is utilization optimization as well as pricing. So the charge point operator can dynamically price based on the time of day, you're charging to drive up, their own utilization of that asset. Because right now, like charge point operators across Europe, their utilization rates in many cases are less than 5%. There's so much money being left on the table, so much money that if they can, based on demand and what's happening, sort of price dynamically, then they can increase that utilization, and then even with expanded margins, drive even more revenue for themselves. So that's I think, story that's continuing with regards to electrification as a means to support sort of a new energy economy. And so we're really excited around what they're building right now, and they're onboarding some really great customers in Germany right now. So excited to see what comes for them in 2025.
That's cool. So it's almost sort of, if I've understood it right, like a Stripe, but directly for the charge point operators, so they can take their own transactions and monetize their own assets, but then with a kind of Uber dynamic pricing, surge pricing layer built into it.
Yeah, exactly. It's kind of like a systems layer, systems infrastructure layer, so to speak. And with that, I think we see what's happening from a macro perspective. I know everyone's kind of like, oh no, like Chinese EVs are going to flood the European market. Actually, that bodes really well for Carica. Okay. Because the mass market of EVs is very price sensitive. And so if we're going to have this dump of that, actually bodes really well for them, because the charge point operators then can drive up the utilization based off of this platform that Carica is building. So I think if the market tailwinds continue, as everyone says that they are, and kind of what's forecasted, it's really going to sort of be a good driver for them going forward in the future. Yeah, no pun intended when I said driver.
I think I like that. Yeah. Very good. Perfect. So I think when people hear the, climate fintech intersection, they just think carbon markets, right? And so of those two examples you gave us, one there involving carbon markets and carbon credits, but deeper than that, more linked into our food systems and regenerative agriculture, and even links to biodiversity and soil health there. And the other, this sort of invisible infrastructure layer that holds, the EV charging space together. So yeah, it's really interesting that I think it's a much deeper and much more nuanced space than perhaps people even realize it is. So what are the areas within that, or what other areas are you particularly excited about for 2025, and where can you see growth opportunities at this intersection?
Yeah, so I mean, continue to stay bullish on the carbon markets. I think voluntary carbon markets, people have been kind of critical because of the lack of growth. But I think the elements, and I'm seeing some great deal flow right now around addressing the pain points and friction points from a sort of infrastructure perspective in the voluntary carbon markets to essentially unlock growth. Okay. So I think we've been so hyper focus on investing in sort of applications around voluntary carbon markets, as opposed to what are the structural, roadblocks to enabling this to grow. Still very, I think bullish on what does the future of insurance look like.
Yes.
Because when we think about the new projects that need to come online, carbon capture and storage, direct air capture, even like a lot of nature-based projects, they still have a lot of challenge, getting financing. Financiers don't know how to underwrite. The projects are still very risky, so you can't build sort of a risk return profile that you feel comfortable with. And then you don't really have data because you've never done this before. So who's going to actually help you sort of like figure out like, yeah, I have, a lot of conviction that I'm going to get my money back. And so this is where insurance, plays such a critical role in terms of building the bridges to bankability is what I like to say.
Yeah.
So simply building out so many type of insurance products and then using that data at scale to effectively give the traditional financiers of this world, the big banks, and even like the larger insurers, confidence that they can enter into sort of this new climate economy where, their loss ratios stay similar to maybe other projects that they've invested in the past. They're able to, continue to write premium and price effectively, essentially sustain their underlying business model, which for any company, this is kind of the one thing you need to, do to stay relevant in the world. So very excited about kind of the future of climate insurance and climate unlocking kind of bankability at scale for a lot of projects that no one really wants to look at or underwrite at this point.
Yeah.
Which I'm very excited, and if we get there going forward, continue to, I think, and every industry is talking about this. Other points I can make, I'll use this one as the last one, is I think what's unique about climate is, you have a mix of data where it's coming from, public data sources, private data sources. It's just ultra fragmented, not interoperable at all. And this is just continues to be kind of a barrier, period to scale. And so anything, like any type of company, when we think about sort of this future decentralized world that, where we're seeing in the front of our eyes, how's the data actually going to continue to be harmonized, normalized, interoperable, such that we can continue to drive, product creation and productize, in ways that we haven't been able to do, in the past. And so I think that's like maybe one of the biggest opportunities, I think, over the next few years here, because that's also one of these, I think, forcing mechanisms that unlocks a lot more innovation to happen, in climate tech in the next 5 to 10.
Absolutely. It's the one big bottleneck, I think, really, other than access to finance. The other key bottleneck is that access to trusted, verifiable data sets, especially with so many solutions having AI built into them now. And the only way you can train those models effectively is by giving them access to lots of trusted, verifiable data, right? So yeah, I think that'll be a really interesting area to watch for sure. And what's important to you when you're making investments? So if there are companies, or if there are founders listening that are working in one of those spaces, building a solution in one of those spaces, and think that they might like to approach you or approach Anthemis, what's important to you when making investments? What do you look for in a startup? What do you look for in a team to decide that they are an investable prospect?
Yeah, I think the team is founder market fit. Whatever you're out to build, do you have experience in some way, form, or fashion at a big company, at former startups, that gives you credibility that you can actually build the product and distribute that product to essentially start building the company. So that's a blanket, very general sort of answer that probably every VC's gonna say, like some level of founder market fit. But I think for us, especially, I think in climate right now, there's so much greenwashing happening. And so it's really founders that have a very strong handle on a market opportunity, that it's gonna, essentially convincing, us as an investor, this is a sustainable business model that is going to be around for a long time, or that I'm going to essentially create. So not greenwashing, but like a very substantive, approach to building from a product perspective. I think we have to be a lot more critical around that going forward. And then also kind of based on what's happening in the market trends, market tailwinds that can kind of drive that growth. I think with early stage, I don't think we have we like the community founders, investors alike, have the luxury to sit around for 5 or 6 or 7 years. This is probably an exaggeration, with no revenue. It's kind of like, really, how do you sort of, fail fast, as many in Silicon Valley would say, fail fast, find what's going to fit, to build. I think, one of the top investors in Silicon Valley, A16Z, like their tagline now is, it's time to build. They recently changed it. And I think that's the case. But then when you talk about time to build, what are you actually building? And so just that criticality, I think, is going to be very, very important. So yeah, I hope that answered a few. I think we look for a lot of different things. Obviously, an effective distribution or go-to-market is really important. I think the challenge with climate is, this is not a, many of the sort of customers that, many climate tech investors are going to be working with move very, very slow. Like let's say utilities or oil and gas companies or, developer. I mean, it's just structurally, the market is a lot harder to grow. The sales cycles in many cases are horrendously long. And so it's really trying to figure out, if that is the case, that's great. And, kind of once you land, one of these big, let's say utilities, the switching costs are probably going to be very, very high. And you're going to be working with them, for years and years to come. But in the interim, what quick wins can you do to really sort of, get market validation to continue to sort of build and, give your investors confidence that this is something that, will drive returns, for them in the future.
Yeah. Excellent. So those sort of almost quick wins, sort of immediate revenue or additional revenue streams that can be, no, I was going to say exploited, but that's the wrong word, isn't it?
Yeah, just I think it's thinking innovatively around business models.
Yeah.
And creating new ones, really. So I think I'm always just, founders that really kind of even just think about it and how they articulate kind of, like climate, the future unicorns in climate tech, would I argue are they going to be pure SaaS? Probably not. Maybe, but many won't be. And so it's like really thinking about from the nuance of specific industry, kind of how we, how founders build and what models kind of, even if they don't exist now at scale, what would they look like in the future?
Absolutely. And I've seen, startups that I've seen pitching and that I've spoken to from an angel investor perspective, some really interesting kind of multi-layered, models around where they have a piece of hardware that is created, that is undertaking a process. And then there is kind of waste from that process. They're selling that as a revenue stream, whilst also selling the product of their sort of industrial process, which is, powered by an AI layer, for example, and they're then licensing that software as well. So there's kind of those three different revenue streams around one business model, which, is really smart.
Yeah,
awesome. And if founders are looking to raise this year, you mentioned there what you look for in an investable prospect, but in terms of a founder getting ready for a fundraise this year at that stage that you play at, so at that kind of seed to Series A stage, what are the things that you would expect for them to have in place, or a level of market kind of readiness, I suppose, that you would expect them to have at that stage, that if they're wanting to raise this year, they need to start thinking about now so they can demonstrate the right milestones?
Yeah, I think having done their market diligence, having really a full, I think, strong handle around kind of what, the competitors are doing in the right way and also in the wrong way. And also, I think, obviously at a pre-seed, you don't necessarily need revenue, but, having, I think some conviction that, once your product is built, someone's going to at least want to go out and start testing it or piloting it. So I think there's much more, not necessarily just investing in the idea, which, as early stage investors we do, but really kind of what's the substance behind that idea that can help us continue to build conviction. And then obviously as an investor, we're there to help you, in the early stages to get to the next step. I think with everything happening in early stage climate right now, because it's still a relatively sort of new sector and you don't have so many growth stage companies just yet in climate, there's a lot more noise that investors are trying to weed through. And so the more that you can be very articulate around, this is the thesis that I have, or maybe it's based off the investor's thesis, this is how I think it fits into it. What are you seeing? This is how I'm seeing it. And this is why I want to build, this product and get it to market. So I think the more that you can be sort of thoughtful to help the investor do their job in the sense of, look through the riffraff, a lot of everything, all the noise that's going on, and help them kind of see, the opportunity, I think the better. And obviously that goes with storytelling and obviously your charisma and being able to pitch the product and the company and everything else. But yeah.
So I always refer to it as joining the dots. And it's what I say on the flip side, right, where I'm speaking to people looking for jobs, because it's really recruitment is what I do. So if I'm speaking to people that are looking for jobs in climate, one of the things I always say to them is, if you're speaking to a hiring manager, you're applying for a job, you need to join the dots for them. You don't just put your CV in front of them and expect them to pick through it and join the dots about why you're great for this job. Lay it out for them. And I guess it's a similar analogy, right, with founders pitching. Don't just put your pitch out there and expect the investor to join the dots around why this is a great opportunity and why it fits with their fund. Do that extra legwork, join the dots for them.
Yeah, 100%. I mean, that's very well said. I could put it that way. I like that.
There you go. Amazing. And so how can people get in touch with you, Jeremy?
My email is jeremy@anthemis.com or via LinkedIn, Jeremy Brown Anthemis. My name's very common, so if you put Anthemis there, you'll find me.
Perfect. Lovely. Well, thank you so much. Thank you, Jeremy, for your brilliant kind of insights and view on the market. I think that'll be really valuable to many founders out there who are listening.